The interest penalty that the IRS is assessing on underpayments is increasing significantly. What are those rules? What's it changing to? What do you need to look out for? I've got that and more coming up. My name's Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Early in my career, it's a long time ago, feels like a different world. Gosh, what a boomer. I would, sound like a dinosaur. I remember serving folks when I first started, helping people with taxes and tax planning. Remember, there was a retired individual. We had a great relationship, and he's since passed away, but every time we would do planning, it would be, okay, you would need to, Chad, let's call him, Chad, you've got to make sure you send in this amount, let's do this withholding strategy or whatnot. And he'd say, nah, I'm not really interested. I'm okay owing the government just as long as, I'm not, it's not catching me by surprise and making a cash flow pinch. I'm like, well, eventually it was, hey, well, you've got interest. There's going to be a late payment or an underpayment penalty. And the reasoning was, and this was not common back then, but it was not so rare you didn't hear it. Occasionally people would say it and have this philosophy. Well, I'd rather keep the money in my bank account because I can earn interest on it, and then the IRS will charge a little penalty via interest. But as long as I've got the money in my pocket, I'm earning more than what the IRS is charging me. Well, at the time, it's so long ago, I can't tell you for sure that was the case. I do know this is well before 2008, so interest rates were probably in the 5%, 4 to 5%, and inflation was lower than that. And so it's very possible that the Fed's interest penalty was lower, and this individual was right. I always wanted to be penalty free, and that's been the guidance that we often coach people with is, hey, avoid tax surprises, and one of those surprises is having to pay a penalty. So even if you owe and you're comfortable with that, make sure you avoid a tax surprise, and hopefully that includes avoid a penalty, and then also identify and capture all of the right tax planning opportunities to reduce the amount of tax you pay over your lifetime, if not multiple lifetimes. That's sort of the agenda of tax planning. All right, well, before we get into the change, let's just make sure we're all on the same sheet of music here. If you are just working a regular W-2 job, and that's essentially all your income, then you're having withholdings, tax withholdings from your paycheck. And hopefully you filled out that W-4. They've made that overly complicated recently. Hopefully you filled that out correctly and the right amount is being withheld. And when you file your taxes, about the right amount is being withheld, and you might break even or get a small refund. That's how it should work in kind of most situations. But if you have other income that is landing on your tax return that it does not have withholdings, and what could this be? This could be Social Security. It could be a pension. It could be interest. I've shared that this is the first time in ages people are actually receiving interest on their bank accounts, and so it's very possible you could have a tax surprise because now you've got a bunch of interest you need to report. Could be dividends, capital gains, those sorts of things. So if you have other income, either because you are, well, obviously a big one would be self-employed individuals or folks that have a side hustle, right? That self-employment income is landing on your tax return, Schedule C, or if it's a partnership, 1065, or if it's an S Corp or LLC, could be 1120 tax form, K1. So all of that lands on your return, and there likely isn't tax withholdings to offset it. So therefore, what do? You then need to either increase your withholding somewhere else, or you need to pay what's called quarterly estimates. And done a lot of videos on these. It'd be really simple if quarterly estimates were every quarter. They're not. The schedule need to be paid by the tax filing deadline. That's the first quarter, so typically April 15. And then just 2 months later, the second quarter then is due June 15. The third quarter is 3 months after that, so September 15. And then the fourth quarter is actually January 15th of the next year. And so that's when the IRS expects quarterly payments, and how they want it in order to ensure that you're not, going to have to be, paying a penalty is they want that payment spread out evenly, and they want it to be the right amount. or essentially they want it to be in the quarter in which you receive the income. So if you have a capital gain because you sold some Apple stock and you sold it in the first quarter, the IRS technically wants that estimated payment enough to cover the gain or the tax from that sale. They want that in the first quarter. So you can align your estimate so that you don't pay it evenly throughout, but you just pay it in the quarter in which the income was earned. But either way, if you have income that doesn't have withholdings on it, you're going to want to be paying these estimates or do a different strategy to ensure that you're paying the IRS on time and in line with the income that you're receiving. If not, you could face a penalty, and this penalty, like we said, is getting a little bit heftier. Now, what is that penalty? What are those rules? Well, it depends on the level of your income last year and what your taxes are. Typically, if you owe, and this is federal laws, state laws are different. If you owe less than $1,000, typically there is no penalty. If you've paid in 100% of last year's tax or 90% of this year's with a couple exceptions, typically there is no penalty. If your income is considered high income, if your adjusted gross income is above $150,000, then instead of 90% and 100%, it's 100% and 110%. So those thresholds get a little bit higher for that. So ultimately for your situation, you're going to want to be aware. If you have other income sources beyond what you would just have withholdings for, this is a financial planning and tax planning strategy that you've got to work with your CFP on, because it touches your cash flow, often touches your, obviously, investments or maybe retirement, and certainly your tax planning. So work with your CFP on that. Well, and again, to encourage you to do so, yeah, the IRS is actually increasing this interest rate, this penalty, moving it up to 8%, where just a couple years ago, before this increase in interest rates, it was 3%. So it's getting more and more meaningful for you to say, no, I need to attend to this and make sure that I've got the right withholding and tax payment strategy to avoid what could now be and will be a heftier penalty if you're subject to it. So going back to Chad, that original example, or that thinking from a few decades ago, yeah, it's unlikely that you're earning enough interest, that you're earning an 8% interest rate somewhere else to keep it in your own pocket instead of paying it into the IRS and avoiding a penalty. To me, for those of you with more complicated situations, own a business or have a side hustle, or have a lot of income from sources that aren't a paycheck where there isn't withholdings, doing the proactive planning work so that you get penalty free, that you get to that safe harbor every year, is very important. Identifying tax shelter strategies so that you can reduce your tax bill, whether it's this year or out there in the future, that's critical. That's critical for those of you in that situation. All of that encompasses figuring out what the strategy is to get penalty free, or so that you stay away from this potential 8% interest penalty. All right, so work with your certified financial planner on that. If you don't have a CFP that's helping you with tax planning, that is one of the 6 areas of your comprehensive financial plan, your financial life. So they've got to be doing that work. So work with your CFP on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or send us an email, info@korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.